Hey there guys, and welcome back to the channel as always. I just want to start this video off real quick by saying thanks to everybody who's been supporting me recently, and for those of you who have barely subscribed in the past week or so, I thank you as well. So anyways guys, let's jump into today's video. So today we're going to discuss on what are bonds. No guys, don't be afraid, I'm not talking about jail bonds or anything, okay? What I'm talking about is financial bonds. So what exactly are these bonds, you may ask? See, take for example, governments and corporations issue bonds in order to raise money from investors when they need new sources of capital to fund for new activities, such as needing a new building or maybe just upgrading on some technology for that company or something. So essentially, you can see it like this. When investors purchase a government bond, they're basically letting the government borrow money. Hey there government, I hear you're making a new company down the road. Here, let me let you borrow some money. Thanks. Thank you very much. We'll give you back your money with some interest down the road. And when investors buy a corporate bond, they're basically letting a corporate borrow money as well. So it's the same thing for both ways, okay guys? Hey there corporate, I hear you needed some money to start a new project of some sort. Let me let you borrow some money real quick. Oh gee, why thanks investor. I needed this money to fund for my new activities. I will pay it back and some interest down the road in a few years. So boom guys, there you have it. Basically, it's just borrowing money to a corporate or a government in order to fund their activities. So like a loan, a bond basically pays a periodic interest payment known as a coupon to the bond holder. And at the end of the bond's life, which is called maturity, the principal is all paid back to the investor plus the interest. So essentially, when you let them borrow money, guys, you're getting paid back some interest. So it's almost like a CD with banks, but this is to governments and to corporations. So like the example I mentioned earlier before, let's say a company wants to raise $1 million to build a new manufacturing plant or something. Well, then that's when they will issue these bonds to hopefully raise the money in order to build that new manufacturing plant. So let's say each bond will be issued at $1,000. This is basically known as the face value of the bond, if you may say. Now in this example, the company or bond issuer, as we may say also, offers a coupon of 5% per year to be paid annually. So in this case scenario, the bond will mature after 5 years, at which time the company will repay the initial $1,000 face value to each bondholder. So it's almost like you're just holding your money and you're just leaving it and letting it build you some more money, okay? Almost like stocks. Now, there are many different types of bonds, and usually government and corporation bonds remain the largest sector of the markets when it comes to bonds. Now in general, corporate bonds are known to be the most riskiest of the bonds, meaning you could lose your money with these type of bonds, but just like stocks guys, it's obviously going to give you back the highest rewards with these bonds. And government bonds are usually the safest type of bonds that you can afford. So if you're out on the market for a bond, be sure to do your research on this and see what the risk and return for these type of bonds are before purchasing any type of bond at all. Like I said again, government bonds are usually considered the low risk type of bonds. But this is not always usually true though, okay guys? Because you see, you need to be aware that when it comes to emerging markets, meaning maybe it's like a city of some sort that's barely, I guess, coming up, you know, you have a higher risk when purchasing these government bonds as well, okay? Because you don't know what could happen in the future. Maybe something happens and you end up losing your money or some sort. But at the same time, if the economy in that area does really well, it's going to reward you back even a little better. So do be aware of these government bonds, okay? Not all of them are low risk, okay? Now when it comes to corporate bonds, they usually fall into two different categories: investment grade and speculative grade, also known as either high yield or junk bonds. Now when it comes to speculative grade bonds, they are basically issued by companies perceived to have lower credit quality and higher risk default than more highly rated or investment grade companies, okay? So remember, when it comes to corporate bonds, there's going to be two categories, okay guys? The speculative one, which hence the word speculative, meaning it's not a sure thing. It could go up or down depending how it goes. And then you have the investment ones where they're much safer, but they still carry some sort of risk, okay guys? Now I'm going to list just a few more other different type of bonds just so you can get familiar with what kind there are. So again guys, government bonds, government agency bonds, local government bonds, emerging market bonds, mortgage-backed securities, asset-backed securities, PF and brief, and covered bonds. And those are just a few of some of the bonds that you can purchase out there, okay guys? Again, I'm not going to go over every single one of them because that will take a good amount of time. But if you do want me to go over some of them like that, then just leave me down a comment down below. Maybe I'll do a video on it. But again, guys, when it comes to bonds, essentially they're a safer investment than stocks. But at the same time, they do reward you with a lesser reward than stocks, okay? So again, it's just going to be all about your risk tolerance if you decide whether you want to go with some bonds or with just pure stocks or some sort. Or maybe you can mix it up also as well. Now, historically, long-term government bonds have been given around like 5% on annual returns, which isn't too bad seeing as it does beat inflation. But again, compare that to stocks, which are more volatile. But historically, over the past few years, stocks have earned about at least from a 7 to 10% per year. So again, I mean, it's a bigger reward than bonds, guys. So you might want to consider that as well. But regardless of which one you pick, they're both risky either way. Bonds still carry some type of risk, guys. So it doesn't matter if you decide to go with pure bonds, they do carry some risk no matter what type of investment you decide to actually go with. And usually bonds are sold for a fixed term, usually from 1 year to 30 years if it may be. Now you can also sell a bond on the secondary market before it actually matures, but you do run the risk of not making your original investment or even the principal. So do be aware if you decide to actually sell your bond, guys. These are more long term. So if you know you might need that money later down the road, I would highly consider maybe something else that suits your needs as far as investment wise. Now another note to take is that as interest rates climbs, so do the coupon rates of new bonds hitting the market. So what this basically means is that it makes newer bonds more attractive to buy, and it kind of diminishes the resale value of your older bonds that you have already owned. So if you were to try to sell your bond that you had for a few years already, you're not going to get much out of it because it had a lower rate when you had it compared to the newer ones who have a little bit more of a higher rate. So I mean, obviously you're going to want to buy the higher rate ones because it's going to give you more of a return on your money. So that's another risk that you might want to factor in if you decide to actually sell your bonds, okay guys? Now again, like I mentioned earlier with stocks and bonds, usually with investors, they usually have a mixture of both in their portfolios. Because you see, having bonds in your portfolio can usually balance out risk over time if stocks decide to go down at a certain point. So if a certain week or so stocks are doing really poorly, but you also have bonds on the side in your portfolio mixed in, it usually balances it out so you're not losing too much money at the moment. So again guys, just to wrap it up with this video, again, bonds are basically just letting someone else borrow money, but it's mainly going to be a government or a corporation. And again, it do carry some type of risk as this is an investment and any investment carries any risk. So don't think just because this is the safest type of investment that it's going to be with no risk or anything like that. So I hope this video helped clear things out on what bonds are. Again guys, not jail bonds. And as always, if you like this video guys, be sure to give it a like. Leave me down a comment down below. Let me know what you guys think. And if you haven't already and you're watching this, be sure to subscribe as well. And I'm just going to wrap it up and I'll see you guys in the next video. Alright guys, later.